Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the recent macroeconomic issues and developments in India and overseas. Well, there are some issues that just don't go away. So this week we're going to take a hard look once again at the rupee, more correctly the amazing appreciation of the rupee, ironically even as the economy seems to be going nowhere. How is one to make sense of it all? In April this year, when we did a show on the rupee, I'd asked the panelists whether anybody had thought the rupee would strengthen to below 65 to the dollar because it had touched over 68 late November. And with Trump in the saddle, the dollar was expected to strengthen and the rupee to depreciate in tandem. Instead of which, with the rupee continuing to appreciate, today I'm returning to the same question to ask you, did any of you ever imagine the rupee would strengthen to below 63 and 64 to the dollar? Remember, not all that long ago, there were predictions that the rupee would touch 70 to the dollar. And today we're seeing predictions that it will touch 62.50 to the dollar by March 2018. So what is going on? Are forex markets clairvoyant? Or are they plainly foolish? To help us join the dots, I have with me three of the best brains on the subject. Ananth Narayan, Regional Head Financial Markets, ASEAN South Asia, Standard Chartered Bank. G. Padmanabhan, former Executive Director, RBI and presently Non-Executive Chairman, Bank of India. And Ajay Sahai, DG and CEO, Federation of Indian Exporters Organization, FIO. Welcome to the show, all three of you. Let me start with you, Anand, since you were there last time as well. We'd all agreed then that apart from importers in the political class, and one doesn't attach too much importance to political classes' understanding of these issues, no one really sees a strengthening of the rupee as an unmitigated blessing. So why are the authorities not doing anything? Or is it that they're not doing enough? Or is it that there's no such thing as the right value of the rupee to start with?
Look, straight away I'll start off by admitting, and it's difficult to admit, that I didn't expect rupee to come to where it is. Beginning of the year, the base case that I had penciled was for rupee to go through a mild depreciation. Instead, what we've seen is fairly strong appreciation. I think a lot of factors have gone into explaining why rupee is where it is. To start with, there is the dollar globally itself has weakened quite a bit. Mythili, there's a lot of echo coming up. Yeah, the dollar itself has weakened quite substantially, which explains many currencies strengthening against us. Secondly, the prospects for India itself have improved quite a bit. Ever since we had the election results coming out of rupee, it seems to give indications of political stability in India. But I think one large reason which contributes to the outperformance of rupee against other currencies, rupee is the best performing of all the major currencies, is also to do with the nature of our monetary policy. You know, this goes back to the old postulate of the impossible trinity, that once you have an independent monetary policy that is, especially that is inflation targeting, you will have ramifications onto the capital flows and into the FX markets. Now, because interest rates are seen by the market as being higher than what they need to be, you do see inflows coming into the FX markets through capital flows. We've seen substantial amount of FPI debt flows coming through this year. We also see interest rate differentials to be seen by the market as being on the higher side. So 1 year forward premium in paisa terms still is about 3 rupees for every dollar, which means, you know, exporters are tempted to sell, whereas importers are tempted to stay away from hedging. And people who borrow in foreign currency are tempted to stay away from hedging as well. So what we are seeing happening is an increase in unhedged exposures on the back of a variety of factors, but monetary policy is probably one of them as well. And we're also seeing a strengthening trend of the rupee on the back of this unhedged exposure, which frankly has ramifications for economy. Now, particularly if you look at the yuan-rupee move over the last 1 year, this is not good for domestic industry. Given that we import $60 billion of manufactured goods, so we are causing the domestic economy.
Padmanabhan, Anand clearly seems to think that the monetary policy is the villain, and because interest rates are higher than what they ought to be, we have a huge inflow of funds apart from unhedged exposures adding to the problem. But for the benefit of our viewers, can you explain what exactly do we mean when we say the rupee is overvalued or undervalued? If the reference is to its real and effective exchange rate today vis-a-vis some earlier date, then that assumes that the exchange rate at the starting point was a fair valuation. Also, most of the overvaluation they're talking about right now is vis-a-vis the dollar, and vis-a-vis the other currencies, there hasn't been that much of appreciation. So what would she be concerned about? Should we be concerned about the appreciation vis-a-vis the dollar or vis-a-vis our competitors? And what exactly do we mean by overvaluation, Padmanabhan?
I think having spent more than 3 decades in the Reserve Bank of India, I must admit that I have never fully understood how the market sees this as an overvaluation or undervaluation. It is always with reference to a parameter, the real effective exchange rate. Now, whether the real effective exchange rate is the basis on which one needs to come to a conclusion whether the rupee is overvalued or not, I think that's a question which we can debate in a probably another episode of yours. But there has always been this issue. So if you take the history of how the rupee valuation has been vis-a-vis the real, I think except for few points of time, there has always been this divergence. Now the question is, how does Reserve Bank of India manage? I mean, I don't go obviously to the issue whether the monetary policy was the villain. This is again something on which I don't want to specifically comment on. Although monetary policy alone, whether it will bring stability as far as the exchange rate is concerned, that's a question on which I hold the view that given the kind of restrictions and issues that we have on the foreign exchange market, that may not exactly replicate the interest rate differentials for the obvious reasons. This was one stance that I took personally as far as the 2013 is concerned. So I think the monetary policy being the answer to the rupee valuation is a theory that I don't fully subscribe to.
Oh yes, there can be as many theories as perhaps there are economists or even observers. But Ajay, the fact is that exports and exporters have been suffering for many months now. But for some reason, their pleas seem to be falling on deaf ears. In fact, even the Commerce Minister, who should be arguing your case, has been defending the strong rupee. So either the old ideas about the role of exchange rates in promoting exports is no longer valid, and exports are in fact not suffering, or the argument is that the FIO is no longer able to lobby the case on behalf of exporters effectively. So which is it? Ajay?
No, in fact, if you look at the currency movement, compare these currency over a long period, let us say from April 2014 to December 2016. In this period, dollar appreciated by around 12%, euro depreciated by around 15.7%, pound depreciated against rupee by around 18.77%. And now if you look at a period, let us say from January to July, in this period, rupee appreciated against dollar by around 6.64%. It appreciated against euro by around 2.5%, against pound by around 2.84%. So there is absolutely no discernible trend. Rupee movement against dollar is little different as compared to rupee movement against euro or pound. Secondly, I also hold the view that of course exchanges is very important for export, but it is not the sole factor which drives export. And historically also Indian exports have been more attuned to the growth in global trade rather than on exchange front. There are years when rupee has depreciated, exports decline. On the contrary, when rupee appreciated, exports have shown 20% plus growth. So I do subscribe to the view that the appreciation of rupee is posing problem for export, because many of the emerging economies currencies are either depreciating or they are appreciating at a much slower pace than rupee. From that perspective, since exports, they basically compete in the global market, it is all not that what your currency behave, it is equally important how your competitors' currency behave. In that perspective, I do admit that the appreciation of rupee is causing problem for exports, but I will not put the entire blame on the exchange rate for the decline or growth in Indian exports. There are other reasons also which are equally important to push exports growth.
Okay. So Anand, Ajay says exchange rate is not the only villain really, but old school economists will tell you that a currency that moves in response to trade flows is likely to be much more stable than one that is driven by capital flows like the rupee. Do you agree? Or is it that in the brave new world of today, it is a given that exchange rates will increasingly be determined by global capital flows, and that makes countries like India much more vulnerable than countries like China, where the exchange rate is determined essentially in response to trade flows? Anand?
Yeah, Mythili, just before I answer your question, a couple of clarifications. Just to clarify, I'm not for a minute suggesting that monetary policy is the sole reason why rupee has appreciated. There are obviously plenty of other reasons, including dollar weakness globally, including the fact that there's been a market change in the Indian macroeconomic scenario over the last few months. But monetary policy, as the impossible trinity postulate says, is clearly going to have an impact on FX, and we are watching that as well. Second, just to clarify on the point you made about overvaluation of the rupee and who knows what the right level is, you're absolutely right. Nobody can actually put a finger on what the right level of the rupee is. It's a huge matter of debate. All I can say is, look, the RER seems to suggest we are about 20% overvalued if you go by the 36 country RER. But we know that's not a perfect measure because it doesn't take into impact the improvement in productivity that you see in India vis-a-vis other countries. So it's a very, very debatable number, the RER. All I can say is the quality of the appreciation that you're saying, which comes back to your question, the fact that the RBI has actually bought $50 billion worth of, increased the reserves by about $50 billion, both on spot and forwards put together. Where is the dollars coming from? If you go by current account deficit and if you go by FDI flows, and if you even take into account FPI equity flows, it doesn't amount to $50 billion. It doesn't come anywhere close to $50 billion. Yet RBI has mopped up these dollars. Now, where has that come from? Clearly, it's coming from FPI flows into debt. Clearly, it's come from exporters hedging. Clearly, it's come from people taking ECBs and not hedging. Clearly, it's come from importers not hedging. So the whole point, as Mr. Padmanabhan was saying as well, of unhedged exposures going up and contributing to this rise in rupee, actually tells you that the quality of appreciation is very suspect and it's probably not healthy. Last point on trade, impact on trade. Look, we make a lot of song and dance of rupee impact on exports, which I think is a redundant topic, and there's a lot of inelasticity about exports and rupee, which has been debated earlier. What we don't take into account is the impact of exchange rate on imports. If you look at what's been happening since the beginning of this fiscal year, April, May, and June, our trade deficit is now at about $13 billion plus every month, right? Non-oil, non-gold imports are going up as well. If you look at Chinese yuan against rupee, Chinese yuan has depreciated by 7% over the last 1 year or year and a half against the rupee. Now, for a country like ours, which imports so much of manufactured goods from China, despite having an underemployed workforce, a weakening Chinese yuan from whom we import is not good news for domestic industry. So the whole point about export promotions, is one aspect. I think the impact of import substitution is something which you need to debate a lot more, which is clearly impacted by the movement of rupee.
Absolutely, but we'll come to the issue of what is exchange rate hurting? Does it hurt exports? Does it hurt imports? Who gains, who loses? But after a break. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of the appreciating rupee. Why is the currency of a country whose economy is weakening? Why is it strengthening? And I have with me Padmanabhan, Anand, and Ajay Sahai. Padmanabhan, would you agree with Anand that trade flows are important, but it's going to be increasingly driven by capital flows? Should we be agnostic about the reasons, the underlying reasons for the currency's movement? After all, there are two ways of dealing with excess. One is to allow capital to come in and then try and mop up the excess if you think it's excess. The other is to try and discourage inflows. Let me take the first, mopping up the excess. And here there seems to be a huge tussle between the RBI and the government over who's going to bear the cost of that intervention. And that seems to be one of the reasons for less aggressive intervention from the RBI. But whatever the reason, is the net result a bit like Nero fiddling while Rome burnt? Padmanabhan?
Mythili, let me start off by saying that most of the things that Anand said, I completely subscribe to, I agree. And this also goes to the question that you raised about the quality of the flows and which is more sustainable. And that's a precise point. I think most of these issues that we are discussing, that's the point. When this entire exchange rate is moving based on capital flows which are reversible, then to say that we will always find the right level of the rupee to ensure that all the market players and all the stakeholders get the right value, that is something which is very difficult in a situation, because when the reversal happens, I think controlling that becomes much more difficult than the situation in which we are in today. Having said that, I think given that this country always has a history of inflation, to have an intervention on a very aggressive basis, I think whether the government and the RBI at loggerheads, I don't know, but I don't think so. That is more of an imagination. But the problem is, even on the central bank side, I think it will be extremely difficult to sustain this aggressive intervention because of the impact that will have on the rupee liquidity. then how do we do the sterilized intervention? That has raised its own issues with regard to even the instruments available with the Reserve Bank of India in the past, and that could very quickly become issues as and when we move forward, when these capital flows continue. So the point that I'm trying to make is that in China, the reserve is owned reserve because it's all account of the current account surplus. In a way, our reserve is all borrowed reserves because this is mopped up on account of temporary mismatches in the market. In such a situation, to argue that we should always find the right level of the rupee, I think would be little difficult to achieve in practice.
You're dead right, Padmanabh, on that. And Ajay, which brings me to the question that presumably an exchange rate that is determined more by capital flows than by trade flows is likely to be far more volatile. But yet Indian corporates don't seem to believe in hedging their risks. Why is it? Is it because it adds to their costs and Indian corporates typically like to operate on very thin margins? Or are they just being plain greedy? After all, the past few months, we've seen only one-way movement. And you know your members much better than either Anand or Padmanabhan or I. So maybe you could tell us why is it that exporters, for instance, are not hedging against the risk of further appreciation, which seems very much on the cards given the way overseas investors seem to be so enamored of India. Ajay?
In fact, if you look at the export sector, there are a number of sectors where there is natural risk. For example, take the petroleum products. Whatever we are exporting, 90% plus of that is crude which is coming in the way of imports. So big companies who are exporting petroleum product, they are naturally hedged on the import side. Same is the case for gems and jewelry sector. The import intensity of the sector is 90% plus, and so is true for electronic sector. So the three segments, petroleum product, gems and jewelry, electronic, which together would account for around 135% of India's exports. They are in a way naturally hedged. In other sectors also, over a period of time, import intensity of India's exports is going up, maybe because of the easier accessibility of imports, the duties coming down. We have more economic engagement with many countries where we have signed free trade and SICA, and with imports becoming competitive, definitely the import intensity of the export is going down. That is also precisely the reason. I do agree that there is a large section of the exporters who may be having a kind of unhedged position. We are always telling them to cover your risk. If you look into the forward cover, the rates of the forward covers are coming down. It was for 1 year, earlier you were getting around 67.30 rupees to a dollar. Now it has come down to around 66.50 rupees. So in their situation also, we are asking the exporter that at least 3/4 of your export order should be immediately hedged as soon as you finalize the order. But for certain sectors, definitely since they have the natural hedging, they may not be going for that. But I think the position which we are talking about, the exporter, is equally true of the corporates and banks. Around $150 billion has been raised by the banks. $159 billion is the corporate debt as on 31st of March 2016, and most of that is also unhedged. So while I do agree that in export sector there is need to increase the hedge, but that equally applies to Indian banking system and Indian corporates as well.
Yes, absolutely. Ajay, you're right on that, because it's not just exporters. Exporters, at least some section of exporters, do have some kind of natural hedge, which is not true of many other corporates. But Anand, Padmanabhan raised an issue. He said when the RBI intervenes more, if it were to intervene rather more aggressively, there would be issues on the liquidity front, and there it is handicapped by the fact that increase in liquidity could have implications for inflation. But are there other instruments to control that excess liquidity, Anand?
Yeah, before I go into that, Mythili, just a quick point on the earlier question and Mr. Ajay's response. While I agree with Mr. Ajay, and I think he makes some very good points, I think from a macroeconomic stability problem situation, the bigger issue is the fact that we are not seeing enough importers hedging, and we are not seeing enough people who are borrowing in foreign currency hedging, rather than exporters hedging or not hedging. See, as I mentioned earlier, we have a situation today where we are seeing a lot of unhedged flows coming in through FPI and debt. We are seeing exporters increasing their hedge ratios, and we are not seeing importers hedge. That contributes to the net inflows into the RBI coffers, which, as Mr. Padmanabhan pointed out, when things go bad, will go back. It's not permanent liquidity or permanent reserves as in the case of China. So, which is what leads to a possibility of vulnerabilities and financial instability. So, while every client and every individual has the right to hedge or determine the right hedges, I would also strongly urge the importer community and people who have borrowed in foreign currency to carefully explore and examine the fact that while things look very good right now, buying insurance at this point in time when it is pretty cheap might be a good idea. On intervention and RBI's choices here, look, there are no easy choices. The point about the impossible trinity is it's impossible, which means that you have to compromise, you have to pick and choose as to what you think is more important at any given point in time. But I do think there are a few things which could help. One is RBI clearly has been doing a considerable amount of forward cover as well. So as one means of sterilizing the liquidity, they are buying dollars in the forward market as opposed to buying it only in the spot market. So we've seen $30 billion worth of spot intervention. We've seen an incremental $20 billion of forward intervention since the beginning of the year. Now, one problem of forward intervention that RBI does is it could also help support or push up forward premia, which in turn begets more exporter flows and keeps importers away and keeps people who bought foreign currency away. So one suggestion that RBI could possibly consider is to possibly stay away from the forward market. Because there is no perfect interest rate parity in India, you could see forward markets go up and down depending on demand and supply with no relation to underlying money markets. Forward premium would then come down to levels where exporters would balk at hedging at those rates and importers may be enticed to come in and start hedging if forward premium come down. It's of course all in theory. We don't know how practice will work, but that is one option to consider. The second option, look, on the liquidity front, when I'm saying don't use the forward market, that leaves you with OMOs, that leaves you with MSS, that leaves you with short-term bond instruments to suck out the liquidity. Obviously, as you mentioned earlier, Mythili, that comes with a cost, either a fiscal cost or a cost for the RBI. There are no easy choices here to be made.
Yes, and it's true. It's a bit of damned if you do and damned if you don't. But Padmanabhan, earlier we spoke about two choices, that either you let the money come in and try and mop up the excess, or you try and do something to restrict the inflows. And the fact is that unlike in the past when capital controls were a no-no, today that's not the case. So is it time we started exploring other avenues to reduce the inflows by, say, for example, going slow on increasing limits for FDI, FPI, sorry, not FDI. FDI is always welcome, but not portfolio investment, allowing only long-term funds, making ECBs more restrictive. Have we really explored these avenues fully? Are we too scared of Western views on this? Padmanabhan?
Well, Mythili, I think as a person who has always been associated with the market, I think I would hate to think in terms of any type of controls now. But I think there are a few other issues. Let me try to take off from what Anand said and Ajay said and try to argue out a point. And some of the suggestions that I put in place, we had thought through earlier, at least I had thought through earlier, but it could be, to some people, it would be completely unacceptable. But let me make that point. I think, as Anand said, the issue would be that do you intervene in the spot market or the forward market? That is a $1 million question. I think Reserve Bank always faces this problem, and I think they go to the forward market precisely because of the liquidity issues that will come about as far as the spot market is concerned, and it's never the intention to distort the forward market. As everybody awares, it happens, but it's a matter of compulsion. But let's go back to the point which Ajay said, and if this is accepted in some way, this will create some kind of mitigation in the market, is that Ajay made a point that when there is a natural hedge, people don't hedge. But I tend to disagree with that. When these people who are having matching flows or the matching income, inflows and outflows, they again go to the market and hedge that part which suits them, depending upon where the foreign exchange market is. This creates a double whammy as far as the market is concerned. So I for once have always been arguing that when there is a liquidity mismatch, that should be addressed through the swaps rather than outright forwards in the market. So can we say that the corporates or the entities who have natural hedges but differing cash flows obviously are allowed to cover this through swaps, and only the net position where there are plus or minus, that should be allowed to be hedged in the market? This is something which we considered, but I think it would be considered blasphemy as of now, taking away the freedom of the corporates to do whatever they want in the market. But the banks are not allowed to do that. Today the banks, when they are having a liquidity mismatch, I don't think a treasury goes to the market and does an outright and try to double the position or create more open positions, number one. Number two, about the macro-prudential measures that Reserve Bank of India took, while I completely appreciate and agree with what Anand said, now that I am on the other side, the problem that we face is that this macro-prudential regulations always hit the banks. Now the banks will have to make more capital, the banks will have to find more resources for an inaction on the part of the corporates. Whether this can be carried forward, I think this is a debatable point.
Yes, indeed, there are many reasons for us to worry, but I'm afraid we've come to the end of our allotted 25 minutes, so I'll have to call this discussion to an end, with the hope that we don't find ourselves meeting again 3 months down the line with the rupee strengthening to, say, 60 to the dollar. With the dollar index weakening, anything is possible. The fact is that the availability of foreign capital is not an unmixed blessing. It certainly alleviates domestic resource constraints, but it can also destabilize the economy in two ways. One, excess capital inflows can result in asset price inflation, as we're seeing in the stock market, and there's also a loss of competitiveness through overvaluation of the exchange rate. Two, we can have a sudden outflow because of risk aversion, and that can trigger a currency crisis. The only thing that we in India can do is beef up our defenses, both against sudden stops and worse reversals. Thank you so much, Anand, Padmanabhan and Ajay, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now. In the meantime, if there's any topic that you'd like to see discussed in this forum, please do write in to us at the email ID you see at the bottom of your screen.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.